There's a rhythm to commerce that most people never notice. Walk into any mall in America, watch the flow of shoppers, listen to the buzz of transactions, and you might think consumer behavior is random, unpredictable, driven by individual whims and personal circumstances. But you'd be wrong, because beneath the surface chaos, beneath the seasonal sales and the holiday rushes and the back-to-school promotions, there's a pattern, a cycle so consistent that once you see it, you can't unsee it. And understanding this pattern is the difference between retailers who thrive and those who close their doors, between marketers who build brands and those who burn through budgets, between investors who make fortunes and those who watch their portfolios evaporate. The pattern goes like this. Every 5 to 8 years, consumer confidence swings from extreme optimism to deep pessimism and back again, not gradually, not smoothly, but in waves that build momentum, crest dramatically, and crash with devastating force. These aren't random mood swings. They're not isolated events. They're part of a predictable cycle that has repeated itself for over a century, through world wars and technological revolutions, through booms and busts, through every generation since economists started measuring these things. The cycle starts with optimism. Consumers feel confident about their jobs, their incomes, their future. They spend freely, borrow enthusiastically, and believe prosperity is permanent. Retailers expand, marketers increase budgets, investors pour money into consumer stocks. Then something shifts. Maybe unemployment ticks up. Maybe stock prices falter. Maybe home values stop rising. The shift is subtle at first, but confidence begins to erode. Consumers start saving instead of spending. They delay purchases. They trade down from premium brands to value alternatives. Retailers see traffic decline. Marketers watch campaigns fail. Investors exit positions. And then the cycle bottoms. Pessimism dominates. Consumers hunker down, convinced the bad times will last forever. They cut spending to essentials. Luxury becomes a dirty word. Discretionary purchases stop entirely. Retailers go bankrupt. Marketing budgets get slashed. Stock prices of consumer companies crater. But here's what most people miss. The bottom is also the beginning, because after pessimism peaks, confidence starts rebuilding. Slowly at first, then faster. Consumers who hoarded cash start spending again. They upgrade purchases. They try new brands, they take risks, and the cycle repeats. 5 to 8 years from peak to peak, 5 to 8 years from trough to trough, like clockwork. Let me show you why this matters. If you're a retailer and you don't understand this cycle, you'll expand at the peak when confidence is highest, but conditions are most fragile, loading up on inventory and signing leases just before the crash. You'll cut to the bone at the bottom when confidence is lowest, but opportunity is greatest, missing the recovery that makes fortunes. If you're a marketer and you don't understand this cycle, you'll waste money on brand campaigns when consumers are pessimistic and focused only on price, burning through budgets that deliver nothing. You'll pull back on spending when confidence returns and consumers are receptive, letting competitors capture the rebound. If you're an investor and you don't understand this cycle, you'll buy consumer stocks at the peak when everyone is optimistic and valuations are stretched, riding the portfolio down. You'll sell at the bottom when pessimism dominates and prices are lowest, locking in losses and missing the recovery. The cycle punishes those who ignore it and rewards those who respect it. Always has, always will. So let me show you exactly how it works, why it repeats with such precision, and what you need to do at each phase to survive and profit. The cycle begins with data. Not opinions, not feelings, but measurable indicators tracked month after month, decade after decade. The Conference Board releases the Consumer Confidence Index every month. It surveys 5,000 American households, asking 5 simple questions about current economic conditions, expectations for the next 6 months, and plans for major purchases. The answers get aggregated into a single number, with 100 representing the benchmark level from 1985. When the index is above 100, consumers are optimistic. They expect income to rise, jobs to be plentiful, business conditions to improve. Below 100, they're pessimistic. The University of Michigan releases a similar measure called the Index of Consumer Sentiment. It asks different questions but tracks the same underlying psychology. How confident are people about their economic future? These aren't trivial surveys. They're leading indicators that predict economic activity 3 to 6 months ahead, because consumer spending represents 67% of US gross domestic product. When consumers feel confident, they spend and the economy grows. When they feel pessimistic, they save and the economy contracts. Here's the key insight. These indices don't move randomly. They follow a pattern that mirrors the business cycle itself, but with specific characteristics that make the consumer confidence cycle distinct. Research from the Federal Reserve shows that consumer confidence typically begins declining 1 to 2 quarters before a recession officially starts. It peaks before the economy peaks. It troughs before the economy troughs. It's not reacting to conditions, it's anticipating them. And the cycle from peak confidence to trough confidence and back to peak averages 5.5 years, with individual cycles ranging from as short as 3 years to as long as 10, but clustering tightly around the 5 to 8 year range. Why 5 to 8 years? The answer lies in how business cycles themselves work. The National Bureau of Economic Research tracks US business cycles dating back to 1854. Since World War II, the average expansion, the period from economic trough to peak, has lasted 65 months, about 5.5 years. The average recession, from peak to trough, lasts 11 months. Put them together, and you get a full cycle of roughly 6.5 years, peak to peak or trough to trough. Consumer confidence follows this rhythm because it's driven by the same underlying forces that create business cycles, employment, income, credit availability, and asset prices, especially housing and stocks. But consumer confidence isn't just passively tracking the economy, it's actively shaping it. This is where behavioral economics enters the picture, the insight that John Maynard Keynes called animal spirits back in 1936. Keynes understood something that pure economic models missed. People don't make decisions based solely on rational calculation. They make decisions based on emotion, instinct, confidence, and fear. When confidence is high, people spend money they don't have yet, borrowing against expected future income. They make major purchases, buying cars, appliances, furniture, taking vacations. This spending creates demand, which drives production, which creates jobs, which generates income, which validates the initial optimism and creates more confidence. It's a self-reinforcing cycle, but it works in reverse too. When confidence falls, people cut spending even if their current income hasn't changed. They're not reacting to reality. They're reacting to fear about the future. They postpone purchases. They pay down debt. They save more. This behavior reduces demand, which forces businesses to cut production, which leads to layoffs, which validates the initial pessimism and creates more fear. Another self-reinforcing cycle, but in the opposite direction. This psychological dimension is what makes the consumer confidence cycle so powerful and so predictable. It's not driven by external shocks alone. It's driven by collective emotion that builds on itself until it reaches an extreme, exhausts itself, and reverses. Think of it like a pendulum. Push it in one direction and it swings far, but physics guarantees it will swing back. Consumer confidence works the same way. Optimism builds until it becomes irrational exuberance, the phrase Federal Reserve Chairman Alan Greenspan used in 1996 to describe stock market speculation. Consumers believe prosperity is permanent. They overlever, they overspend, they take risks that only make sense if good times last forever, and of course they don't. Something triggers doubt. Maybe it's rising unemployment. Maybe it's falling stock prices. Maybe it's tightening credit. The trigger varies, but the psychology is always the same. Doubt becomes caution. Caution becomes fear. Fear becomes panic, and optimism collapses into pessimism. Then pessimism dominates for months or years. Consumers believe the bad times will last forever. They underlever. They underspend. They avoid risks that would actually be rational at depressed prices, and eventually this extreme pessimism exhausts itself too. Conditions stabilize, fear fades, confidence rebuilds, and the cycle starts again. Now let me walk you through the specific phases of the cycle and what they mean for your business decisions. Phase 1 is peak optimism. This is when consumer confidence indices are above 110, sometimes reaching as high as 144, which was the all-time peak in May 2000. At this phase, unemployment is low, wages are rising, stock prices are near record highs, and home values have been climbing for years. Consumers feel wealthy, they feel secure, they believe the good times will continue indefinitely. This is the phase where the phrase "this time is different" enters the conversation. Maybe it's because of new technology. Maybe it's because of better monetary policy. Maybe it's because the economy has fundamentally changed. The reasons vary, but the belief is the same. The old rules no longer apply. Recessions are a thing of the past. Consumer behavior during peak optimism is characterized by maximum spending and minimum saving. Personal savings rates drop to historic lows, sometimes below 3% of disposable income. Credit card balances expand. Auto loans surge. Mortgage debt grows. People are borrowing against future income that they assume will arrive. Retail sales boom, not just for necessities but for discretionary items. Premium brands thrive. Luxury goods sell. Consumers trade up, buying the nicer car, the bigger house, the more expensive vacation. Restaurants are full. Hotels are booked. Shopping malls are crowded. For retailers, peak optimism feels like paradise. Revenue grows quarter after quarter. Same-store sales increase. Margins expand because consumers aren't price-sensitive. They're willing to pay full price. They're not hunting for deals. Retailers respond by expanding. They sign new leases. They open stores in secondary markets. They increase inventory, betting that demand will continue rising. They hire aggressively, staffing up for growth that seems limitless. For marketers, peak optimism is the golden age of brand building. Consumers are receptive to aspirational messaging. They respond to lifestyle advertising. They want to be associated with premium brands that signal success. Marketing budgets grow. Companies invest in expensive campaigns, celebrity endorsements, event sponsorships. The focus shifts from price and value to image and status. For investors, peak optimism drives consumer stocks to elevated valuations. Price-to-earnings ratios expand. Retail stocks trade at multiples that assume perpetual growth. Companies that cater to discretionary spending see their share prices soar. Investors pile in, chasing momentum, convinced that consumer spending will continue indefinitely. But here's the critical insight. Peak optimism is not the time to expand, increase marketing spend, or buy consumer stocks. Peak optimism is the most dangerous phase of the cycle, the moment of maximum risk disguised as maximum opportunity. Why? Because peaks don't last. They precede crashes, always, without exception. The historical data is unambiguous on this point. In 1999 and 2000, consumer confidence peaked at record levels, with the index reaching 144 in May 2000. The stock market, particularly technology stocks, was soaring. Consumers felt invincible. Then the dot-com bubble burst. The economy entered recession in March 2001. Consumer confidence collapsed to below 100 within months, eventually bottoming at 85 by October 2001. In 2006 and 2007, consumer confidence recovered to 105, with housing prices at all-time highs and unemployment at 4.4%. Consumers were borrowing record amounts against home equity. Subprime mortgages proliferated. Retail sales surged. Then the housing market peaked in mid-2006. Home prices started falling. Subprime mortgages defaulted. Bear Stearns collapsed in March 2008. Lehman Brothers filed for bankruptcy in September 2008. The economy entered the worst recession since the Great Depression. Consumer confidence cratered to 25 in February 2009, the lowest level ever recorded. From peak to trough, confidence fell 76%. More recently, in early 2020, just before the COVID pandemic, consumer confidence was at 132. The longest economic expansion in US history was in its 11th year. Unemployment was at 50-year lows. The stock market had tripled since 2009. Consumers were spending freely. Travel was booming. Restaurants were thriving. Then COVID hit. Lockdowns shut down entire sectors of the economy. 40 million workers were furloughed or laid off. Consumer confidence plunged to 86 in April 2020. The pattern repeats because the psychology repeats. Peak optimism creates the conditions for its own destruction. Consumers borrow too much. Businesses expand too aggressively. Asset prices rise too far. When something, anything, triggers doubt, the entire structure built on optimism collapses. So if you're a retailer and you recognize that confidence is at peak levels, this is not the time to sign long-term leases or commit to major expansions. This is the time to reduce debt, build cash reserves, and prepare for the downturn that history says is coming. If you're a marketer and confidence is peaking, this is not the time to launch expensive brand campaigns assuming consumers will remain receptive. This is the time to lock in customer loyalty and test value-focused messaging for when conditions change. If you're an investor and consumer stocks are trading at elevated multiples while confidence is at peak levels, this is not the time to increase exposure. This is the time to take profits and move to defensive positions. Phase 2 is the erosion. Confidence doesn't collapse overnight. It erodes gradually at first, dropping from peak levels but remaining above 100. Consumers are still optimistic on balance, but the extreme confidence is fading. This phase can last 6 months to 2 years, depending on how quickly economic conditions deteriorate. The erosion phase is characterized by subtle shifts that most people don't notice until they're obvious. Unemployment stops falling and stabilizes. Wage growth slows. Stock prices become volatile, rising and falling without clear direction. Home price appreciation decelerates. Credit conditions begin tightening as banks become more cautious about lending. Consumer behavior starts changing, but the changes are incremental. Savings rates tick up slightly. Big-ticket purchases slow. Auto sales decline. Furniture and appliance purchases are delayed. Consumers don't feel crisis yet, but they feel uncertainty. For retailers, the erosion phase is tricky. Revenue growth slows but doesn't turn negative. Same-store sales go from increasing 5% annually to increasing 2%. Traffic softens, conversion rates decline. Retailers respond by increasing promotions, offering discounts to maintain volume. Margins compress but remain positive. Most retailers don't recognize this as a warning sign. They blame temporary factors, weather, competition, consumer preferences shifting. They don't see the cycle turning. For marketers, the erosion phase shows up in campaign performance metrics. Click-through rates decline, conversion costs increase. Brand campaigns that worked brilliantly 6 months ago now deliver marginal returns. Consumers are becoming more price-sensitive, more willing to shop around, more receptive to value messaging. But marketing departments often respond by doubling down on the strategies that worked during peak optimism, increasing spending to overcome the declining effectiveness, which just burns more budget for diminishing results. For investors, the erosion phase creates volatility. Consumer stocks that were market darlings start underperforming. Earnings reports miss expectations. Companies guide lower for future quarters. Valuations begin compressing as investors become less willing to pay premium multiples. But corrections are mild, 10 to 15% drawdowns that get bought back up. Most investors interpret this as normal market fluctuation, not the beginning of a longer downtrend. The key challenge of the erosion phase is recognition. Because confidence is still positive, because the economy hasn't entered recession, because retailers are still growing and consumers are still spending, it's easy to miss that the cycle has turned. But the data is there for those who know where to look. Consumer confidence surveys show declining expectations for the next 6 months, even if assessments of current conditions remain strong. Sentiment about future employment and income is weakening. Plans for major purchases are being scaled back. If you can recognize the erosion phase early, you gain a significant advantage. Retailers who recognize it can adjust their expansion plans, focusing on profitability rather than growth, strengthening balance sheets while competitors are still borrowing to expand. Marketers who recognize it can shift messaging toward value and reliability rather than aspiration and lifestyle, building relevance for the downturn ahead. Investors who recognize it can reduce exposure to consumer discretionary stocks and increase positions in consumer staples and defensive sectors that perform better when confidence is falling. But most market participants don't recognize the erosion phase until it's too late. They're still operating on the assumptions of peak optimism, assuming conditions will stabilize and confidence will rebound. By the time they realize the cycle has turned, they're already deep into Phase 3. Phase 3 is the collapse. This is when consumer confidence falls below 100 and continues dropping, sometimes reaching levels below 50. The collapse phase coincides with recession, when economic indicators turn negative across the board. Unemployment rises, incomes stagnate or fall, stock prices drop significantly, home values decline, credit becomes scarce as banks pull back from lending. The triggers for collapse vary. In 2001, It was the bursting of the dot-com bubble and the September 11th attacks. In 2008, it was the subprime mortgage crisis and the failure of major financial institutions. In 2020, it was the COVID pandemic and the economic lockdowns. But the mechanism is always the same. Some event shatters the assumption that good times will continue, forcing consumers to confront economic fragility they'd been ignoring. Fear spreads, optimism evaporates, confidence collapses. Consumer behavior during the collapse is characterized by panic and retrenchment. Spending on discretionary items stops almost entirely. Purchases are limited to necessities, food, utilities, basic healthcare, debt payments. Consumers who can afford to pay cash do so, avoiding new borrowing. Those who are over-leveraged face forced deleveraging as credit lines are cut and loans are called. Savings rates spike, sometimes reaching 30% or higher as people hoard cash for the uncertain future they now see clearly. Delayed purchases become indefinitely delayed. No one is buying cars unless their current vehicle is literally breaking down. No one is remodeling homes. Vacations are cancelled. Dining out plummets. Retail traffic collapses. For retailers, the collapse is catastrophic. Revenue doesn't slow, it drops. 20, 30, 40% year-over-year declines are common in discretionary categories. Stores that were profitable during peak optimism are suddenly losing money. Inventory that was ordered months ago arrives into a market with no demand, forcing deep markdowns and destroying margins. Rent obligations that seemed manageable become crushing when sales fall by half. Retailers that expanded during peak optimism now face the consequences. All those new leases, all that inventory, all those employees, they become liabilities. Cash burns through reserves. Lines of credit get drawn down. And for those without financial cushion, bankruptcy becomes inevitable. The collapse phase sees waves of retail bankruptcies. Clothing chains, department stores, specialty retailers, furniture companies, they file Chapter 11 or liquidate entirely. Circuit City in 2009, Borders in 2011, Toys R Us in 2018, J.C. Penney, Neiman Marcus, J. Crew, all in 2020. The pattern is consistent. Retailers that overextended during boom times cannot survive the bust. For marketers, the collapse renders most traditional campaigns ineffective. Brand advertising becomes irrelevant when consumers are focused purely on price and necessity. Aspirational messaging feels tone-deaf when people are worried about job security and mortgage payments. Marketing budgets get slashed because companies need to preserve cash, and even when budgets exist, consumer receptivity is near zero. The only marketing that works during collapse is value-focused, price promotions, bundle deals, financing options that reduce upfront cost. Brands that can credibly position as affordable alternatives gain market share. Premium brands watch customers defect to mid-tier and discount competitors. For investors, the collapse is where the majority of losses occur. Consumer discretionary stocks fall 50, 60, 70% from their peaks. Companies that survive see their valuations compressed to single-digit price-to-earnings ratios as investors assume profitability will never recover. Companies that don't survive see stock prices go to zero. Investors who bought at peak optimism or during the erosion phase watch their portfolios crater. Those who sell during the collapse lock in maximum losses. The critical insight about the collapse phase is that it's inevitable given the conditions created during peak optimism, but it's also temporary. Consumers perceive the bad times as permanent. They believe conditions will never improve. They're wrong. History shows that every collapse is followed by recovery. Every trough in confidence is followed by rebuilding. Every bottom creates opportunities for those who recognize that the cycle will turn again. If you're a retailer and you're still operating during the collapse, your priority is survival. Preserve cash, renegotiate leases, cut costs ruthlessly. Accept that revenue will be depressed and focus on getting through the downturn with your business intact. If you're a marketer, accept that brand. Building is futile during collapse. Focus exclusively on value propositions and maintaining customer relationships so that when confidence rebounds, your brand is positioned to recapture share. If you're an investor, the collapse is the opportunity. The businesses that survive will recover, and their stock prices at the bottom represent value that only appears once per cycle. But buying at the bottom requires courage because everything feels hopeless. The data says you're crazy to buy. The sentiment is universally negative, Yet history shows this is exactly when fortunes are made. Phase 4 is the trough. Consumer confidence stops falling and stabilizes at low levels, typically between 60 and 80. The trough phase coincides with the end of recession and the beginning of recovery, though consumers don't recognize it as recovery initially. Economic indicators stop getting worse. Unemployment peaks and starts declining slowly. Stock prices find a floor and begin rising, often before the economic data improves. Business conditions stabilize. The crisis that triggered the collapse passes, and the acute fear subsides, replaced by persistent pessimism. Consumer behavior at the trough is characterized by extreme caution despite improving conditions. Even though job losses have stopped and some hiring resumes, consumers don't trust the recovery. They remember too well how quickly things fell apart. They keep saving at elevated rates. They avoid major purchases. They remain focused on necessities. Spending does increase slightly from collapse levels, but only marginally. For retailers, the trough is where survival turns into endurance. Revenue stops falling, which is a relief, but it doesn't bounce back quickly. Same-store sales stabilize but remain well below pre-recession levels. Margins remain compressed because price sensitivity persists. Consumers are willing to spend slightly more, but only if they get value. This is the phase where discount retailers and off-price chains gain significant market share. Consumers who traded down during the collapse often stay with cheaper alternatives during the trough, having learned they can live without premium brands. For marketers, the trough is the beginning of opportunity, though it doesn't feel like it. Consumers are still pessimistic, still price-focused, but the worst of the panic has passed. This is when smart marketers start shifting messaging away from pure price toward value propositions that emphasize quality, reliability, and smart spending. The goal is to position brands for the recovery that's coming, even though most competitors are still in survival mode. For investors, the trough is where significant gains begin. Stock prices of consumer companies that survive start recovering, sometimes doubling or tripling from their lows, as investors recognize that earnings will rebound. The companies that filed bankruptcy are gone, reducing competition and allowing survivors to gain market share. Valuations remain depressed relative to future earnings potential, creating opportunity for those who can look past current conditions and anticipate the cycle's next phase. The challenge of the trough is psychological. Everything feels bad even though conditions are improving. Consumers don't trust the recovery, businesses don't trust demand, investors don't trust the rally. Pessimism dominates sentiment even as data improves. Those who can overcome this psychological barrier and recognize that the trough represents the transition from downturn to recovery position themselves for the gains that come in Phase 5. Phase 5 is the recovery. Consumer confidence starts rising from trough levels, climbing back above 100. This phase coincides with economic expansion, when growth returns, jobs are created, incomes rise, and optimism gradually replaces pessimism. The recovery phase typically lasts several years, building momentum as confidence feeds on itself. Consumer behavior during recovery transforms from cautious spending to increasing confidence. Savings rates decline gradually. Major purchases resume. Auto sales recover. Housing markets stabilize and then strengthen. Discretionary spending increases as consumers feel more secure about their financial situations. The trading down that occurred during collapse and trough reverses, with consumers upgrading to mid-tier and premium brands again. For retailers, recovery is when profitability returns. Revenue growth resumes, often accelerating as pent-up demand is released. Margins expand as price competition eases. Retailers who survived the downturn are leaner and more efficient, positioned to capture market share from competitors who didn't make it. This is when strategic expansion resumes, but led by disciplined operators who remember the lessons of the last cycle. For marketers, recovery is the golden opportunity. Consumers are receptive again. Brand campaigns work, aspirational messaging resonates, budgets increase. Companies that maintained customer relationships during the downturn now convert that loyalty into revenue growth. Market share gains made during tough times compound during good times. For investors, the recovery generates substantial returns. Consumer stocks rise as earnings recover and eventually exceed pre-recession peaks. Valuations expand as confidence in sustained growth increases. Companies that were bought at trough valuations deliver multiples of initial investment. New businesses emerge, capitalizing on changed consumer behaviors and the opportunities created by the collapse of legacy players. The recovery phase eventually transitions back to peak optimism, completing the cycle. Confidence keeps rising, unemployment keeps falling, stock prices keep climbing, and gradually, almost imperceptibly, the psychology shifts from cautious optimism to confident exuberance. Consumers forget the last recession. They believe good times will last. They borrow more, spend more, take more risk. Retailers expand more aggressively. Marketers increase budgets, assuming receptivity will remain high. Investors pile into consumer stocks, assuming growth will continue indefinitely. And the stage is set for the cycle to repeat. Peak optimism leads to erosion. Erosion leads to collapse. Collapse leads to trough. Trough leads to recovery. Recovery leads to peak optimism again. 5 to 8 years from peak to peak. 5 to 8 years of human psychology playing out in predictable patterns that have repeated for over a century. Now let me show you why this cycle is so consistent, why the 5 to 8 year time frame keeps appearing, and what drives the psychological swings that make it predictable. The key is understanding that consumer confidence is driven by 4 primary factors: employment, income, wealth, and credit availability. These 4 factors are themselves cyclical, tied to business cycle dynamics that have been studied extensively. Employment is the most direct driver of consumer confidence. When unemployment is low and jobs are plentiful, consumers feel secure. They're confident they'll continue earning income. They're willing to spend and borrow because they trust they'll be able to make payments. When unemployment rises and jobs become scarce, confidence collapses. Even consumers who still have jobs become fearful, worried they might be next. This fear triggers the spending pullback that accelerates economic contraction. The business cycle creates employment cycles. During expansions, businesses hire, unemployment falls, labour markets tighten, wages rise. This lasts for years as economic growth creates more jobs, but eventually some shock disrupts the expansion. Maybe interest rates rise too much, maybe commodity prices spike, maybe a financial crisis erupts. Whatever the trigger, businesses start cutting costs. They lay off workers, unemployment rises. This reduces consumer income and spending, creating a negative feedback loop. The economy contracts until unemployment peaks. Then gradual recovery begins. Businesses start hiring again. Unemployment falls slowly. Confidence rebuilds. This employment cycle from low unemployment through rising unemployment back to low unemployment typically takes 5 to 7 years, matching the consumer confidence cycle timeframe. Income is closely related to employment, but includes wage growth and other sources of income like investment returns. During expansions, wages rise as labour markets tighten and workers have bargaining power. Over time, opportunities increase. Bonuses and commissions grow. Stock market gains create capital income. Real estate appreciation creates wealth effects. Consumers see their incomes rising and project that forward, assuming it will continue. This income optimism drives spending beyond what current income alone would support, because consumers borrow against expected future income. During contractions, wage growth stops. Layoffs reduce household income. Overtime disappears, bonuses evaporate. Stock market losses destroy capital. Real estate values fall. Consumers see their incomes falling or stagnating and become conservative, cutting spending to match reduced income or even below current income as they save defensively. The income cycle from rising wages through stagnant wages back to rising wages again tracks the business cycle closely, creating the same 5 to 8 year pattern. Wealth effects are powerful drivers of consumer confidence, particularly in countries like the United States where home ownership and stock ownership are widespread. When home prices rise, consumers feel wealthier even if they don't sell. When stock portfolios increase, retirement accounts grow, creating confidence about financial security. This wealth effect translates directly into spending, as consumers feel comfortable consuming more when their net worth is rising. The wealth effect works in reverse too. When home prices fall, consumers feel poorer and cut spending even if their employment and income haven't changed. When stock portfolios decline, retirement security feels threatened and spending drops. The housing and stock market cycles create wealth cycles that amplify confidence cycles. Housing markets tend to run in longer cycles than the business cycle itself, often 7 to 10 years from peak to peak, while stock markets can cycle more quickly. But both contribute to the 5 to 8 year consumer confidence cycle because their periods of rising prices overlap with economic expansions and their crashes coincide with recessions. Credit availability is the fourth driver, and it's particularly important because it enables consumers to spend beyond their current income. When credit is easy, when banks are willing to lend, when mortgage standards are loose, when credit cards increase limits, consumers can and do borrow to fund spending. This amplifies the boom. Consumers who feel confident about the future use credit to pull forward consumption, buying today what they expect to afford tomorrow. When credit tightens, when banks reduce lending, when mortgage standards tighten, when credit card limits get cut, consumers are forced to reduce spending regardless of their income or confidence. They must delever, pay down existing debt, which reduces consumption and amplifies the bust. Credit cycles are driven by financial institution behavior and regulatory policy. During expansions, banks compete for market share by loosening lending standards. They assume good times will continue and borrowers will be able to repay. They lever up their own balance sheets, borrowing to lend more. This works until defaults start rising. Then banks panic, tighten standards dramatically, and pull back from lending. This credit crunch accelerates economic contraction. Recovery requires credit to flow again, which happens slowly as banks rebuild capital and confidence. The credit cycle from easy credit through credit crunch back to easy credit typically takes 5 to 7 years, again matching the consumer confidence cycle. These 4 factors, employment, income, wealth, and credit, interact in self-reinforcing ways that create the boom-bust pattern. During booms, all 4 are positive simultaneously. Jobs are plentiful, incomes are rising, wealth is growing, credit is available. Consumers are optimistic and spend freely. This spending drives economic growth, which creates more jobs, raises incomes, increases wealth, and encourages more lending. The positive feedback loop builds for years until it reaches unsustainable levels. Consumers are over-leveraged, asset prices are inflated, credit standards have deteriorated, the economy is vulnerable to shocks. When a shock arrives, the loop reverses. One factor turns negative, triggering others. Job losses reduce income, reduce spending, create more job losses. Falling asset prices destroy wealth, reduce confidence, reduce spending, push asset prices lower. Credit tightens, forcing deleveraging, reducing spending, creating more defaults, causing more credit tightening. The negative feedback loop accelerates downward until it reaches levels of such pessimism and undervaluation that recovery becomes possible. The pendulum swings to the opposite extreme. This is why the cycle is so consistent. It's not driven by external events, though external events can trigger turning points. It's driven by the internal dynamics of human psychology interacting with economic fundamentals. Optimism and leverage create the conditions for collapse. Pessimism and deleveraging create the conditions for recovery. The cycle repeats because human nature doesn't change. Now let me show you specific historical examples that illustrate this cycle with precision and what successful operators did at each phase. The cycle of the 1990s and early 2000s is a perfect case study. Consumer confidence in early 1991, at the trough of the recession that began in mid-1990, was at 58, one of the lowest levels on record at that time. The economy was in recession, unemployment was rising. The Gulf War created geopolitical uncertainty. Commercial real estate had crashed after the savings and loan crisis. Consumers were deeply pessimistic. But that pessimism marked the trough. The recession ended in March 1991. Recovery began. Confidence started climbing. By 1993, it was back above 100. By 1995, it was at 110. By 1998, it reached 130. The expansion became the longest on record. Unemployment fell from 7.8% in mid-1992 to under 4% by 2000. The stock market tripled from 1991 lows. The internet revolution created perceived wealth as technology stock valuations soared. Consumers felt invincible. Home ownership expanded, credit card debt grew, auto sales boomed. Retailers expanded aggressively. Consumer confidence peaked at 144 in May 2000. Unemployment was at 4%. The stock market, particularly the Nasdaq, had reached bubble valuations. Dot-com companies with no profits were worth billions. Consumers were spending as if prosperity was permanent, but that peak was the top of the cycle. Within months, the dot-com bubble started deflating. Nasdaq peaked in March 2000 at over 5,100 and began falling. By October 2002, it was at 1,100, down 78%. The economy entered recession in March 2001. Corporate scandals at Enron and WorldCom shook confidence. The September 11th attacks traumatized the nation and disrupted commerce. Consumer confidence collapsed from 144 to 85, a 40% drop, by November 2001. The spending patterns during this cycle illustrate the phases precisely. During the early 1991 trough, discretionary spending was minimal. Auto sales were depressed. Retail struggled. But discount retailers like Walmart and Target gained share as consumers traded down. Restaurants saw traffic decline, with fast food gaining share over casual dining. During the recovery from 1991 to 1995, spending gradually increased. Consumers returned to mid-tier brands. Auto sales recovered, housing strengthened, retail sales growth resumed. During the boom from 1996 to 2000, spending exploded. SUVs became status symbols. McMansions proliferated in suburbs. Luxury brands thrived. Consumers borrowed heavily against home equity and stock market gains to fund consumption. Then, during the collapse from 2000 to 2002, discretionary spending cratered. Auto sales fell sharply. Travel plummeted after September 11th. Retailers saw traffic collapse. Apparel sales dropped. Big-ticket purchases stopped. The businesses that thrived during this cycle understood the pattern. Walmart continued expanding throughout the entire cycle, but particularly during the downturn when consumers were trading down. The company's revenue grew from $44 billion in fiscal 1993 to $245 billion by fiscal 2004, a compound annual growth rate of over 18%. Walmart gained enormous market share during the 2000 to 2002 downturn, as consumers who had shopped at higher-end retailers switched to Walmart for value. Amazon, which launched in 1994, built its business during the boom but positioned itself as a value alternative. When the dot-com bubble burst and most internet retailers disappeared, Amazon survived because its focus on low prices and convenience aligned with the next phase of the cycle. The company went public in 1997 at $18 per share, soared to over $100 during the bubble, crashed to $6 by 2001, but then recovered because its business model was sound. Investors who bought Amazon at the 2001 trough made 50 times their money over the next decade. Conversely, the retailers that failed during this cycle were those that expanded too aggressively during peak optimism. Service Merchandise, a catalog showroom retailer, declared bankruptcy in 1999 after overexpanding in the late boom phase. Montgomery Ward, which had been in business for over a century, liquidated in 2001, unable to compete after accumulating too much debt during the late 90s expansion. The cycle from 2002 to 2009 provides another clear example. Consumer confidence bottomed in November 2001 at 85 and began recovering as the recession ended. The Federal Reserve cut interest rates to 1% to stimulate the economy. Housing became the focus of consumer wealth creation and spending. From 2002 to 2005, confidence climbed steadily, reaching 110 by 2006. Housing prices doubled in many markets. Mortgage lending exploded, with subprime mortgages making home ownership accessible to buyers who previously couldn't qualify. Consumers borrowed against home equity, extracting hundreds of billions of dollars to fund consumption. This was peak optimism built on a foundation of housing debt and inflated home values. Unemployment was 4.4%. Stock prices had recovered from the 2000 to 2002 collapse. Retail sales were strong. SUV sales dominated the auto market. Consumers were upgrading kitchens, buying second homes, taking expensive vacations. The housing ATM, as it was called, felt like free money. Retailers expanded to capture the spending. Home Depot and Lowe's aggressively opened stores. Furniture retailers expanded. Apparel chains added locations. Restaurant chains grew footprints. Everyone assumed the housing wealth effect would continue indefinitely. But confidence peaked in mid-2007 at 105. Home prices peaked in 2006 and started falling. Mortgage defaults began rising. Subprime lenders started collapsing. By early 2008, The crisis was spreading to prime mortgages and major financial institutions. Bear Stearns failed in March 2008. Lehman Brothers failed in September 2008. The economy entered the worst recession since the Great Depression. Consumer confidence collapsed from 105 in mid-2007 to 25 in February 2009, a 76% drop. That 25 reading remains the lowest consumer confidence level ever recorded. Unemployment soared from 4.4% to 10%. Stock prices fell 57% from peak to trough. Home values fell 30 to 50% depending on market. Household wealth was destroyed, on a scale not seen since the 1930s. Consumer spending collapsed. Auto sales fell from 17 million units annually to under 10 million. Discretionary spending stopped. Restaurants saw traffic drop 20 to 30%. Apparel sales cratered. Furniture and appliance purchases stopped. Travel fell dramatically. Credit card usage declined as consumers either couldn't borrow or chose to pay down debt instead. The retailers that survived this cycle were those that either catered to value-conscious consumers or had fortress balance sheets. Walmart again gained share massively. Dollar stores like Dollar General and Family Dollar saw explosive growth as middle-class consumers traded down. Discount clothing chains like TJ Maxx and Ross thrived as consumers sought value. Costco's membership model and low prices drove continued growth, even as competitors struggled. Conversely, retailers that catered to aspirational consumers or that were over-leveraged filed bankruptcy in waves. Circuit City liquidated in 2009. Linens and Things closed in 2008. Sharper Image, Stephen Barry's Bombay Company, all gone. Department stores that relied on discretionary spending and carried heavy debt loads, like Mervyn's and Goody's, closed. The businesses that thrived were those positioned for pessimism and value focus. Amazon again gained enormous market share during the 2008 to 2009 collapse. As consumers cut spending overall, they shifted what spending remained to online channels where prices were lower and selection was broader. Amazon's revenue grew from $19 billion in 2008 to $34 billion by 2010, nearly doubling during the worst consumer recession in 70 years. Investors who bought Amazon stock at the 2009 trough around $40 per share saw it reach $3,000 within a decade, a 75-fold return. Apple thrived during the downturn by launching the iPhone in 2007, just as the cycle was turning. The iPhone wasn't positioned as a luxury good, though it was expensive. It was positioned as transformative technology that delivered value by replacing multiple devices. Apple's revenue grew from $24 billion in 2007 to $65 billion by 2010, growing through the recession by capturing share in a new category. The recovery from 2009 to 2020 illustrates the cycle's final phases. Confidence bottomed at 25 in February 2009 and began recovering slowly. The recession officially ended in June 2009, though unemployment continued rising to 10% in October 2009. Consumers remained pessimistic throughout 2009 and 2010 even as conditions improved. Confidence didn't return to 100 until early 2012, nearly 3 years after the recession ended. This was the trough extending into early recovery. But from 2012 forward, confidence built steadily. Unemployment fell from 10% to 3.5% by early 2020. Stock prices tripled from March 2009 lows. Housing recovered, with prices surpassing 2006 peaks in most markets by 2016. The expansion became the longest on record, over 128 months from trough to peak. Consumers who had been traumatized by the 2008 crisis gradually regained confidence. Spending recovered. Auto sales reached record levels by 2015. Discretionary spending returned. Travel boomed. Restaurants recovered. E-commerce continued growing, but so did traditional retail. By late 2019 and early 2020, confidence had climbed to 132. Unemployment was 3.5%, a 50-year low. Stock prices were at all-time highs. Housing was strong. Credit was available. This was peak optimism again, 11 years after the previous trough. The psychology had completely reversed. Consumers who had been terrified in 2009 now believed prosperity was permanent. They were borrowing again. Auto loan terms extended to 7 years. Student debt reached $1.6 trillion. Credit card balances grew, retailers were expanding again, restaurants were opening locations, brands were investing in aspiration messaging, investors were piling into consumer stocks at elevated valuations. Then COVID hit in February 2020. The cycle turned instantly. Lockdowns shut down entire sectors. 40 million workers lost jobs within 2 months. Consumer confidence collapsed from 132 to 86 in April 2020, a 35% drop in 2 months. Spending on travel, dining, apparel, entertainment stopped completely. The collapse was faster and more severe than any peacetime downturn in history, but it was also shorter. Government stimulus payments and expanded unemployment benefits maintained consumer income despite job losses. The Federal Reserve cut rates to zero and bought trillions in assets. Confidence recovered to 100 by July 2021. The recovery was compressed into less than 2 years instead of the typical 5. By late 2021, confidence was above pre-COVID levels in some surveys. This compressed cycle created unique dynamics. Consumers emerged from lockdowns with pent-up demand and government stimulus cash. Spending surged, but supply chains couldn't keep pace. Inflation accelerated to levels not seen in 40 years. The Federal Reserve responded by raising interest rates from 0 to 5.5% in 18 months, the fastest rate increases since the early 1980s. This rapid tightening created new uncertainties. As of early 2025, consumer confidence has been eroding from its 2021 peak. It's currently around 90 to 100, below peak levels but not yet collapsed. Unemployment remains low at around 4%, but wage growth has slowed. Home prices remain elevated, but affordability has deteriorated due to higher mortgage rates. Stock prices recovered from 2022 lows but face uncertainty. Credit is tightening. This looks like the erosion phase of the cycle, the period where confidence is declining but hasn't collapsed, where consumers are becoming cautious but haven't panicked. Historical patterns suggest we're somewhere in the middle of a cycle that peaked in 2021. If the pattern holds, we should expect continued erosion of confidence through 2025 and potentially into 2026 before either stabilizing or collapsing depending on what triggers emerge. The next peak optimism phase likely won't occur until late 2028 or 2029, roughly 7 to 8 years after the 2021 peak. These historical cycles demonstrate several consistent patterns. First, peaks in confidence precede economic peaks by months. The cycle turns before most people recognize it. Second, collapses are faster than recoveries. Confidence can drop 50 to 75% in 12 to 24 months, but takes 3 to 5 years to fully rebuild. Third, the businesses that thrive are those positioned for the phase that's coming, not the phase that's passing. Fourth, consumer behavior shifts are predictable. Trading down during downturns, trading up during recoveries, focusing on value when pessimistic, focusing on aspiration when optimistic. Fifth, the cycle rewards patience and punishes panic. Buying at troughs and selling at peaks requires acting against prevailing sentiment, which is psychologically difficult but historically profitable. So what does all this mean for you as a retailer, marketer, or investor navigating the current cycle? Let me give you specific strategic guidance for each phase, recognizing where we are now and what's likely coming. For retailers, the strategic approach must vary by phase. During peak optimism, when confidence is above 110 and rising, your priority should be profit over growth. Resist the temptation to sign long-term leases or commit to aggressive expansion. Use peak periods to strengthen the balance sheet, reduce debt, build cash reserves. Focus on operating efficiency. When the cycle turns, you'll need that financial flexibility. During the erosion phase, when confidence is declining but still above 90, adjust your product mix and messaging toward value. Start testing promotions and price points that will work when consumers become more cautious. Reduce inventory risk by shortening lead times and increasing inventory turns. Prepare for margin compression by reducing overhead costs. During the collapse phase, when confidence is below 80 and falling, survival is the only priority. Preserve cash ruthlessly. Renegotiate every contract, leases, vendor terms, employee compensation. Accept that revenue will fall, and focus on maintaining positive cash flow, even if it means cutting to the bone. This is not the time for growth. This is the time to outlast weaker competitors. During the trough phase, when confidence bottoms between 60 and 80, position for recovery while remaining cautious. This is when to negotiate favourable leases on locations where competitors have failed. This is when to acquire distressed inventory at deep discounts. This is when to hire talent that's available because competitors are downsizing. But do all of this while maintaining financial discipline because the recovery may take longer than optimists expect. During the recovery phase, when confidence is rising above 80 but below 100, this is when to grow strategically. Expand into markets where competition has been eliminated. Increase marketing to capture customers who are ready to spend again. Invest in technology and infrastructure that will position you for the next expansion. But remember, the cycle will peak again in 5 to 8 years, so grow with discipline that allows you to withstand the next downturn. For marketers, the strategic approach also varies by phase. During peak optimism, this is when brand-building campaigns deliver maximum return. Consumers are receptive to aspirational messaging, lifestyle advertising works, endorsements and sponsorships drive engagement. This is when to establish brand equity that will carry through the next downturn. But recognize that effectiveness will decline as the cycle turns, so don't assume peak performance will continue. During the erosion phase, start shifting messaging toward value without abandoning brand. Emphasize reliability, smart spending, getting more for your money. Test messaging that will resonate with cautious consumers, reduce spend on pure brand campaigns that require ongoing investment, and focus more on performance marketing that delivers measurable returns. During the collapse phase, brand advertising is wasted money. Consumers aren't receptive, they're in survival mode. Slash budgets but maintain presence. Focus exclusively on value propositions and price promotions. The goal is to maintain customer relationships and brand awareness at minimum cost so you're positioned for recovery. During the trough phase, start increasing spend gradually as confidence stabilizes. This is when smart marketers gain share because competitors are still cutting budgets. The messaging should remain value-focused but start introducing quality and differentiation. Position your brand as the smart choice. Better than discounters, but affordable compared to premium alternatives. During the recovery phase, increase budgets aggressively. Consumers are receptive again. Brand campaigns work. Aspirational messaging resonates. This is when to capture market share from competitors who are slower to increase investment. The customers you acquire during recovery often become long-term customers through the next peak. For investors, the cycle provides the clearest opportunity because stock prices amplify the confidence cycle. Consumer discretionary stocks rise faster during recoveries and fall faster during collapses than the broad market. During peak optimism, when consumer confidence is above 110 and consumer stocks are trading at elevated valuations with high price-to-earnings ratios, reduce exposure. Take profits. Move capital to defensive sectors like consumer staples, utilities, healthcare. Don't try to time the exact peak, but recognize that risk is high when optimism is extreme. During the erosion phase, continue reducing consumer discretionary exposure. This is when most investors are still bullish, assuming temporary weakness will pass. Valuations begin compressing but remain above historical averages. Move to cash or defensive positions. If you're active in options, consider buying puts on consumer discretionary sectors as protection. During the collapse phase, most of the damage occurs. Consumer stocks fall 50 to 70% from peak to trough. This is when investors capitulate and sell at the worst prices. Resist that urge. The collapse creates the opportunity. Start identifying high-quality consumer businesses that will survive. Companies with strong balance sheets, essential products or services, market-leading positions. As stocks fall, begin accumulating positions in these survivors. Don't try to catch the exact bottom, but recognize that pessimism creates value. During the trough phase, continue buying quality consumer businesses at depressed valuations. This is when sentiment is worst but opportunity is greatest. Investors who bought strong consumer businesses in March 2009 or March-April 2020 made multiples of their investment. The key is having cash available at the trough to deploy into hated stocks that everyone else is avoiding. During the recovery phase, hold your positions as they appreciate. Consumer stocks in recovery often double or triple from trough prices. As confidence rebuilds and earnings recover, valuations expand. Don't sell too early. The recovery phase can last years. But as confidence approaches peak levels again, typically 5 to 7 years after the trough, start taking profits and reducing exposure. The cycle will repeat. The psychological challenge in all of this is acting contrary to prevailing sentiment. When confidence is at peak levels and everyone is optimistic, you need to be cautious. When confidence has collapsed and everyone is pessimistic, you need to be aggressive. This requires discipline and a longer time horizon than most market participants have. It requires believing that the cycle will repeat, even though every peak feels like the new normal and every trough feels like the new, permanent reality. The data is unambiguous on this point. Consumer confidence cycles have repeated for over a century. They repeated through world wars, technological revolutions, financial crises, pandemics. They repeat because human psychology doesn't change. Optimism builds until it becomes excessive, then collapses. Pessimism builds until it becomes excessive, then recovers. The pendulum swings. 5 to 8 years, peak to peak. 5 to 8 years, trough to trough. Understanding this pattern doesn't make it easy to act on. Psychology is powerful. When everyone around you is optimistic, being cautious feels like missing out. When everyone around you is pessimistic, being aggressive feels reckless. But the pattern says the contrarians are right. The pattern says those who buy at troughs and sell at peaks capture the full value of the cycle. The pattern says those who expand at peaks and cut at troughs destroy value. The pattern says success comes from recognizing which phase you're in and acting according to what history says comes next, not what sentiment says about now. So where are we in the cycle today? As of early 2025, the evidence suggests we're in the erosion phase. Consumer confidence peaked in mid-2021 at levels above 120, has since declined to the mid-90s to low 100s, depending on which survey you reference. Still positive, but declining. Unemployment remains low at around 4%, but job growth has slowed. Wage growth has decelerated. Home prices remain elevated, but sales have fallen due to affordability challenges from high mortgage rates. Stock prices recovered from 2022 lows, but remain below all-time highs and face uncertainty from inflation concerns and Federal Reserve tightening. Credit conditions are tightening as banks become more cautious about lending, particularly for commercial real estate and lower credit quality consumers. Consumer spending remains positive, but growth has slowed significantly compared to 2021 and 2022. Retail sales growth is minimal after adjusting for inflation. Auto sales have declined from their 2021 recovery highs. Travel spending remains strong but is slowing from peak levels. Discretionary spending on apparel and home goods has softened. These indicators suggest we're past the peak confidence phase that characterized late 2021 and into the erosion phase that typically precedes either stabilization or further deterioration into collapse. Historical patterns suggest this erosion could continue through 2025 and into 2026 before either stabilizing at levels around 90 to 100 or potentially collapsing below 80 if triggering events occur. Potential triggers that could accelerate the cycle into collapse phase include a significant increase in unemployment, a major financial institution, failure or credit crisis, a stock market correction of 30% or more, a commercial real estate crisis that spreads to the broader banking system, or a geopolitical shock that disrupts global commerce. Any of these could shift consumer psychology from caution to fear, triggering the spending collapse that defines the collapse phase. Alternatively, the erosion could stabilize without collapsing if inflation continues declining, the Federal Reserve stops raising rates or begins cutting, employment remains strong, asset prices stabilize, and no major shocks occur. In this scenario, confidence would trough in the low 90s and begin recovering, potentially skipping a severe collapse phase and moving into recovery by late 2025 or 2026. Based on historical patterns, a full collapse seems more likely than a soft landing. The excesses of 2020 and 2021, the massive government stimulus, the housing market surge, the stock market bubble in speculative growth stocks, the cryptocurrency frenzy, all suggest an economy that ran too hot for too long. These conditions typically don't unwind gently, they correct sharply. If that analysis is correct, if we are indeed in the erosion phase heading toward collapse, then the strategic implications are clear. Retailers should be reducing expansion plans, strengthening balance sheets, preparing for revenue declines. Marketers should be shifting toward value messaging, testing campaigns for pessimistic consumers, preparing to reduce budgets. Investors should be reducing exposure to consumer discretionary stocks, building cash positions, identifying quality businesses to buy at the next trough. But even if this analysis is wrong, even if the current erosion stabilizes and transitions to recovery without a severe collapse, understanding the cycle framework still provides advantage. Because whether the next collapse comes in 2026 or 2029, whether it's severe or mild, the cycle will repeat. Peak optimism will emerge again, it will erode again, it will collapse again, it will trough again, it will recover again, 5 to 8 years. The pattern is consistent. The businesses and investors who thrive over decades are those who respect this pattern. They don't get caught up in the euphoria of peak optimism. They don't panic during collapse. They recognize that consumer behavior is cyclical, that sentiment swings from extreme to extreme, that the crowds are wrong at the turning points. They act accordingly, patient when others are excited, aggressive when others are fearful, disciplined when others are emotional. This is not market timing in the traditional sense. You don't need to predict exact dates of peaks and troughs. You just need to recognize which phase you're in based on observable indicators like consumer confidence surveys, unemployment trends, credit conditions, and asset prices. Then you apply the appropriate strategy for that phase. During peak optimism, be conservative. During erosion, be cautious. During collapse, be defensive. During trough, be aggressive. During recovery, be confident. The strategy changes as the cycle progresses, but the framework remains constant. The ultimate insight is that consumer confidence is not a reflection of economic reality. It's a driver of economic reality. When consumers are confident, they spend, and the economy grows. When they're pessimistic, they save, and the economy contracts. This creates the self-reinforcing cycles that repeat with such consistency. And because consumer confidence is psychological rather than purely rational, it swings to extremes that create opportunity. Rational analysis says consumers should maintain steady confidence based on long-term fundamentals. But psychology doesn't work that way. Emotions amplify. Herds form. Extremes emerge. And those extremes create the peaks and troughs where the most money is made or lost. If you're a retailer struggling to understand why your strategy that worked brilliantly 2 years ago is failing now, consider where we are in the cycle. Strategies optimized for peak optimism don't work during erosion. If you're a marketer frustrated that campaigns delivering strong ROI last year are now losing money, consider the cycle. Brand messaging that resonates during boom times falls flat when consumers are cautious. If you're an investor confused why consumer stocks that seemed like sure bets are declining despite decent earnings, consider the cycle. Valuations that made sense at peak confidence become excessive when confidence is eroding. The cycle explains what seems inexplicable if you assume consumer behavior is constant. It provides a framework for understanding why the same business can thrive one year and struggle the next, why the same marketing approach can work brilliantly and then fail completely, why the same stock can be a winner and then a loser. The business didn't change, the marketing didn't change, the stock didn't change, the cycle changed, and the cycle will keep changing every 5 to 8 years, as long as humans remain subject to the emotions and instincts that drive confidence and fear. This is the consumer confidence cycle. Optimism builds for years, reaching peaks where consumers believe prosperity is permanent. Erosion begins as doubt creeps in, subtle at first but persistent. Collapse accelerates when triggers force recognition of fragility, driving sentiment from optimism to pessimism in months. Trough stabilizes at extreme pessimism, where consumers believe bad times will last forever. Recovery rebuilds confidence slowly, then faster, as fear fades and opportunity becomes visible. The cycle completes when recovery transitions back to peak optimism, typically 5 to 8 years after the previous peak. The pattern repeats because it's driven by human psychology interacting with economic fundamentals. Employment cycles, income cycles, wealth cycles, and credit cycles all run on similar timeframes, creating synchronized swings in consumer behavior. The businesses that understand this cycle position themselves to profit at each phase, the ones that don't get swept away by forces they never understood. If this framework changes how you see consumer behavior, if you now recognize the pattern in historical data and current conditions, if you understand that what seemed random is actually cyclical, then you have an advantage that most retailers, marketers, and investors lack. Because the cycle continues whether you recognize it or not. But those who see it, who respect it, who act on it, they're the ones who don't just survive the swings, they profit from them. They expand when competitors contract. They market when competitors go silent. They invest when others capitulate. And when the cycle peaks again, when optimism returns and everyone forgets the last downturn, they're the ones preparing for the next turn. Because the pattern always repeats. The only question is whether you'll see it coming. Like and subscribe if this changed how you think about consumer behavior and business cycles. Because understanding this pattern is the difference between surviving and thriving. The cycle is turning. Are you ready?